Hey, everybody, we're going to give it just a minute while folks load into the webinar, and we'll get started off here in just a second. Well, welcome everyone today to our market update. I'm Greg Patterson, and I'm joined with my teammates, J.A. Kennedy, Tara Gould, and Jenn Mann, and we are with Atlantic Wealth Management. And this is our initial 2025 market and economic update. We hope each of you and your families had a wonderful Christmas and New Year's and are having a great January so far. And are y'all ready for the snow here on the Crystal Coast tonight and tomorrow? As I look out the window, it's starting to feel more like snow. Bundle up, it's cold out there. Each quarter we strive to bring you the latest on markets, the economy, and of course our thoughts on where we are headed, and we'll do the same today. We hope these virtual meetings are helpful for you and your loved ones. They're meant to be shared. Don't keep it a secret. And should you have questions or feedback or something we said you want to explore more, feel free to let us know. You can do that by emailing Mackenzie, and you just spell her name, MacKenzie at myatlanticwealth.com, or you can always call us at the office here, 252-515-7800. If you're new to these webinars, we do one each quarter. We appreciate your questions and welcome those. And our next one is scheduled for Monday, April 28th, that afternoon at 4 o'clock. So we invite you to forward this invitation to your friends and family. It's a great way that they can tune into our comments and our thoughts on that. We ask for you to do this because it does help us reach others who might benefit from the work that we do. With that, we have a lot to discuss, so let's get started. I just want to go over our agenda for the day. We want to make sure that we provide a look back, and we will do that. We'll provide you a recap on 2024 returns. Next, Tara will review annual market results across all asset categories, and she'll share some color on this. Also, I want to make sure we review our expectations and outlook for 2025, as well as providing some key tax data updates. And of course, this being the start of tax season, we'll make sure that you know exactly what to prepare for and some items that you should know there, some key takeaways. And lastly, we're going to wrap up with conclusions and our thoughts as far as actionable takeaways. So that will be a full webinar today. And so with 2024 in the history books, and overall it was a good year, Tara, I'd like for you to share a recap with us.
Absolutely. All right, so let's start with the economy. GDP first, U.S. GDP growth rates. This is gross domestic product of the United States. It does increase and decrease over time. And what GDP measures is the total value of goods and services produced within our borders within a specified period of time. What growth indicates as far as GDP growth, just the overall health and expansion of the economy. And you can see here for quarter 4 of 2024, the GDP projection was at 3.1%. This was no change from quarter 3. GDP growth did beat out expectations for the year for 2024. What does that show us? That shows us that our economy is resilient, and it also kept us out of recession territory. Next up is U.S. unemployment rate. This is a key economic indicator. It measures the percentage of the labor force that's unemployed, and key is actively seeking work. It does provide insight to the health of our labor market. We pulled this data from BLS, which is the Bureau of Labor Statistics. And in 2024, we saw unemployment normalize. It rose enough for the Fed to respond in order to cut rates, but not enough to ignite any recession concerns. So a healthy labor market is good. We want that. It definitely supports spending and just overall economic health. So speaking of the Fed, Inflation, that's a common term we talk about all the time. So first of all, what is inflation? Inflation is the rate at which just the general level of price for goods and services increase. And when this increases, what does that do to our purchasing power? Our purchasing power decreases. So in simpler terms, inflation just means over time that our dollar buys fewer or less goods and services. So what we saw for inflation as measured by CPI, it did decrease a bit. So that also supported the Fed to lower rates starting in September, but inflation still remains a risk. And we're going to speak about this a little bit more in our 2025 outlook. Next is the Fed rate, and this is the federal funds target rate. It influences overall economic activity. It affects borrowing costs for us as individuals, as well as businesses and governments. And when the Fed adjusts this rate, it impacts interest rates throughout our economy. So think about loans, mortgages, and interest rates on savings accounts. So in 2024, the Fed did begin to cut rates, a total of 100 basis points. This was less than initially forecasted, but a lot of us can see it reflected in overall interest rates, specifically cash rates on things like savings accounts and certificates. Overall, we ended the year down around 1% for those rates. On to equities. We had a good year for U.S. equities, specifically growth stocks. They led the way. So growth stocks ended the year up around 30%. The S&P 500, this is the index that we use when talking about just general overall market. S&P 500 index was up around 25%, and then came small cap at 12%, international at 6%. We'll talk a little bit more about this on the next slide. So internally, we do have an overweight bias towards large cap growth in our models, which supported large cap growth with the higher returns. And as a reminder, if you're tracking any of the major indices, you're going to hear about things like the S&P 500, NASDAQ, Dow Jones, and Russell 2000. Lastly, we have U.S. bonds. We had another volatile year for U.S. bonds. Even with the Fed cutting rates, we saw longer term bond yields increase, which typically doesn't happen. And for the aggregate index, the income propped returns over appreciation. So the income that the bonds were producing propped returns over capital appreciation. And in 2024, we did make some changes to our overall bond allocations to shift from a shorter term to an immediate term bond. Last note on U.S. bonds is high yield bonds are attractive for the yield, but keeping in mind that they do come with different levels of risk. So just a couple notes for drivers of U.S. bond performance. We have interest rates. Keeping in mind that interest rates and bond prices have an inverse relationship. So as we see one go up, we'll see the other go down. And then, of course, the impact of inflation overall.
Thanks, Tara.
You're welcome. Next, we did mention a few asset class returns in the previous slide, but we also wanted to show you this. So a nice visual chart that shows returns for 2024, and leading the way, we had Bitcoin, which ended the year up 121%. So that would have been from beginning of January through the end of December. I talked about U.S. growth above 33%. And then we have gold coming in third, around 24.5% return, followed by large cap equities. And this is represented by the S&P 500. And then we have value stocks. One more thing I'd like to point out, we talked a little bit about this from a cash standpoint. Cash had a strong year as well with a return of 5.3%. And then one more thing I'd like to introduce you to. Maybe you've seen this if you've come into a meeting with us, but it's called an asset map. And the reason why I show this is probably you're looking at your screen, it looks like a bunch of different colors. That's all I need you to see right now. As far as returns, we've talked about those. But what this list is, it's an illustration, a visual illustration of annual returns for different asset classes. So at the top is the asset class with the best return, and then at the bottom would be the asset class with the lowest return. And this is per calendar year. Main thing I want to point out is that you're going to see different colors at the top and at the bottom for different years. So these return rankings, they do change sometimes dramatically from year to year. That's where diversification comes in. Diversification doesn't eliminate all risk, but this chart, I think, illustrates why diversification is important and helps with that. So as mentioned before, at the top, we have US large cap in 2024. And then at the bottom, we have global bonds specifically for this chart. So if you are fully investing in large cap stock, or we use the example of Bitcoin, you would have been really, really excited for last year because your returns are up. But if we think back, we go back to 2008 and even more recently, 2022, we can see that those asset classes definitely weren't the top performing asset classes. And so keeping in mind that for longer term investors, this is really important to note. Over your invest in life, we're going to see more of this. And so if you look at the chart, this shows us 19 years. And what we see is that US equities have been overall the top performing asset class. And then if we take a look even further, I was thinking about how far can I go back and look at returns? So I found returns from 1926 to 2024. And note that US stocks, as represented by the S&P 500, they did average a return of 10.4%.
Thank you, Tara.
Of course.
Now on to 2025 outlook, and not sure how many of you made any resolutions, but maybe you're not like this couple here. The wife is sitting there. She says, my first resolution of the year is to be more resolute, and my second resolution to resolve the lack of resoluteness I had in my first resolution that I so resolutely ignored in 2024. To which the husband replies, so more of the same. Mm-hmm. And when it comes to 2025, there are some areas where we would say from a market and economic standpoint, we do expect more of the same with some tweaks. And so just wanted to jump in and talk through 2025 outlook briefly. The first, what do you call that? A parallelogram, hexagon, the first hexagon at the top. I just went over this with my kids, so it's a reminder about geometry shapes, but reduced uncertainty. So we've talked about this before. We had elections in November, just had an inauguration. So we've got new leadership in Washington, D.C. Not that that directly impacts the market and the economy, but we have seen historically that after elections, markets tend to be more stable just because we know what we're dealing with for the next at least year and a half or so, or a couple of years until the next, the midterm elections.
The uncertainties removed.
Uncertainties removed. Yes, exactly right. So from that standpoint, that we would say that would be a positive for markets. The next hexagon there, optimistic on the U.S. So we have been more optimistic about the U.S. as compared to international and the rest of the globe for quite some time, and we don't see any reason for that to change. We still expect GDP growth to be positive at very healthy levels, as Tara kind of already mentioned. The last couple the third quarter of the year was around 3%, and we expect the same for the fourth quarter. So as we continue on into 2025, the same things that have driven the economy thus far, which primarily is consumer spending, we would expect that to continue. The consumer in general is still healthy, and although we've continued to see prices increase with inflation, just not as fast as they were a couple years ago, we have seen wage growth over and above. I think we've had 20 consecutive months of wage growth over and above the rate of inflation. So that's positive. And that dovetails the next one going down there, the healthy labor market. Unemployment at 4.1% currently. We've had the last couple of months, we've had job growth over 200,000 jobs for the month. And we did have a couple of months there, the back half of 2024, where we had low growth in terms of number of jobs, but that seems to have rebounded. And from an unemployment standpoint or initial jobless claims standpoint, those trends have remained low. So we would expect that to continue as well into the start of 2025. And then at the bottom there, AI and innovation, that has been a big driver, and we would expect that to continue. We've talked previously about how the Mag 7 or those top 7 largest companies in the S&P 500 index have been a big driver of the overall return. In fact, last year, the overall S&P return, I think over half of that was driven by those Mag 7 companies. And that in large part is because of AI and innovation. What we have started to see a little bit, and we would say this is positive overall for the US and the global economy as well, is that AI and innovation is going to bleed itself into all different sectors and into mid-size and smaller companies as well. So we see that as a positive driver in the future. And then Tara already mentioned this, but lower cash rates with the Fed reducing rates by 1% already. We've seen money market rates decline, and the reality of a 5% money market long term is not a reality, right? That's not going to happen. And what we've seen historically is that you can't just camp out in CDs and money market and outpace the rate of inflation, especially when you consider taxes. So historically, more likely than not, we've seen negative returns in money market when you factor in inflation and taxes on that interest. So we're gonna settle into more normalized environment, I think, from that standpoint. And then inflation remaining a risk. This is probably the biggest thing we're paying attention to as we start off 2025 is just CPI, inflation, and the overall health of the economy. Because I think the Fed has pointed to that being the biggest driver of their stance going forward. So I think the market has had some time to digest that we're not going to enter 2025 with a lot of rate cuts expected. But it remains to be seen, as we get several months into the year, are we able to continue on a growth path with the economy? If that is impacted, if inflation ticks back up, does the Fed maintain rates as they are, or do they look, is there a rate reduction opportunity if the economy starts to decline, or vice versa, if the economy remains healthy and inflation does tick up, does the Fed look to potentially raise rates? And I think that's probably the biggest volatility scenario if we were to see that as we look into 2025. But overall, at the middle there, we've just got the larger diversification box, and we would say that is why we remain diversified. Tara already mentioned it, the cyclical nature of asset class returns. We don't put all of our eggs in one basket. And so we remain focused on that, and that's a big part of our process, investment management process. It will continue to be for 2025.
All right. So now we want to shift gears a bit and take a look at some key data for 2025. And I did want to mention that we will be sending this 2025 key data PDF out as part of our February tax information email. So everyone watching today will get this in email very soon. So here on the first slide, we're just going to take a look, and we can see that for tax year 2025, The top marginal tax rate remains at 37% for individual, single, and head of household taxpayers with taxable income greater than $626,350. And then the 37% also for married couples filing jointly with taxable income greater than $751,600. And the lesser taxable income ranges go up from there, and the applicable marginal rates are also shown in that chart. As it relates to the standard deduction, it was raised slightly across the board for most filers. For single and married individuals filing separately, the deduction rises to $15,000 for 2025, which is an increase of about $400 from 2024. For married couples filing jointly and qualifying widowers, the standard deduction, it rises to $30,000, which is an increase of $800 from tax year 2024. And then, of course, for head of households, the standard deduction will be $22,500 for tax year 2025, an increase of about $600 from the amount for tax year 2024. And then if we take a look at the child tax credit, the maximum credit limit remains at $2,000 for 2025 with a refundable portion of up to $1,700. And of course, the child tax credit income thresholds will also remain the same at $400,000 for those married filing jointly and $200,000 for all other filers. So then if we move along to the second slide of key data, we'll take a look and see that the annual contribution rate for employees who participate in 401k, 403b, governmental 457 plans, and for many of you, the federal government's thrift savings plan, it is increased to $23,500, which is up from $23,000 in 2024. The catch-up contribution limit on these types of plans remains at $7,500 for 2025, with the exception of employees who are 60, 61, 62, and 63, age, of course, who participate in these plans. They will have a higher catch-up contribution limit of $11,250 this year instead of the $7,500. When we look at IRAs, the limit on annual contributions to an IRA remains at $7,000 with a catch-up contribution limit of $1,000 for those ages 50 and over. And the income ranges for determining eligibility to make deductible contributions for traditional IRAs and then contributions to Roth IRAs have all increased for 2025. As it relates to health savings accounts, the contribution limit has increased for 2025 as well. $4,300 is the limit if you're single, with $8,550 being the limit for families. And again, $1,000 catch-up is available for those who are 55 and older. And finally, we'll just touch base on Social Security. As you're probably aware, if your combined income is above a certain threshold, you'll need to pay at least some tax on your Social Security benefits. For single and head of household, qualifying widower, and married filing separately filers, that threshold is $25,000. And then for married filing jointly, that threshold is $32,000. Also, if you begin taking Social Security benefits before full retirement age, which this year is 66 years and 10 months, and you have earned income above certain levels, your benefits will be subject to a reduction. In 2025, you're exempt from any reduction if you are under full retirement age and your earnings do not exceed $23,400. And if you reach full retirement age in 2025, that amount increases to $62,160. And once you reach full retirement age, there is no limit. So you're good to go. Again, this was a lot to throw at you, but all of this will be sent to you in a follow-up email here very shortly. And if there are any questions, we're always available.
Excellent.
So just a little information on tax season in order to prepare. I just wanted to share a few dates with you. We get questions often about where my tax form is going to be available. So for non-retirement accounts, for example, if you have an individual account, you have a transfer on death, a TOD, maybe you have a joint account, you'll receive what's called a consolidated 1099. And so this is going to take those 1099s associated with that taxable account and combine them into that consolidated form. So you might have a 1099 DIV, a 1099 INT for interest, or a 1099B. And then for retirement accounts, if you took a distribution, meaning that you took money out of that account, or maybe you completed a conversion, you'll receive a 1099-R that documents that. Newer, I don't want to say rule or law, but a newer approach to Form 5498. Most people are used to receiving this form. This tracks contributions and rollovers, recharacterizations. This is not going to be available until after tax time. So this is a change across the board. This form is not needed for you to file your taxes. It's just an informational form. Now, it's still very important that you retain it, but it's not needed to file or complete your tax return. Once you do receive this, if you do have a tax preparer, it's recommended that you share this with them, but not required in order to get your tax return completed. So the expected dates for the 1099 forms are starting January 25th through February 12th. I did add a note here that NFS, our custodian, National Financial Services, they can file a 30-day extension for some of the 1099 tax forms. So that would be after February 15th, 2025. And then next, I just wanted to walk you through in Investor 360. Hopefully all of you are set up with Investor 360. If you are not, let's get you set up with Investor 360. We can do it over like a Zoom call, Teams call. You can come into the office and we can show you how Investor 360 is an online platform where you have access to your accounts, and you could also view your documents. You could upload documents. You can message us. But you'll receive an email specifically for taxes. You'll receive an email, and then from here, what you can do is you can click on the link and it'll take you or prompt you to log into your Investor 360 account. Or if you prefer, you can actually go to our website, and from our website, utilize the Investor 360 login. If you'll click next, there you go. Once you're Investor 360, you're going to see that drop down for statements and documents, and you'll click on tax documents. And then the next screen will show you what you have available for your most recent tax documents. And you can see on the left-hand side, it's going to indicate which document it is. So in the example here, we have a couple 1099s and a 5498. And then it'll show you the account name. When you're ready to download this document, you'll just click on that down arrow and it'll download a PDF. And then from there, you're able to save it down, print, maybe message or email your tax preparer. Greg, you're up.
Did we lose him?
Okay.
There he is.
Oh.
It's
coming
worth
back.
noting on the taxes or the tax documents as well that for anybody that does their own taxes, that there is an opportunity, depending on which tax service you use, to automatically pull in 1099s from as opposed to having to manually enter them.
Right.
So we have instructions for that as well, and happy to provide those if needed.
Absolutely.
I'm back.
All right.
He's back.
Some key takeaways we wanted to share with everybody on the call today. Now is an excellent time to review your short-term cash needs and how much you have allocated to cash. When I say short-term, I'm speaking of 0 to 24 months. These would be resources that you would need for a large trip or anything outside of your normal month-to-month living expenses. The reason why we advise you to take a look at that is because rates have declined. And in particular, what we've noticed is the brick and mortar banks have reduced rates sooner, and they've been ahead of the Federal Reserve cutting rates. So if you're not paying attention to that, we certainly do in the meetings, but it's always nice to come back to that and address it. Also, you may have new goals in the new year and need cash for this. And this is a perfect time for us to help you raise that cash to meet the goal. We've had 2 terrific years back to back, 2023 and 2024. And so this is a perfect time to assess your short-term goals and how much cash you might need. Sometimes this happens what we would call sporadically or on demand. And we don't want you just to save the money indefinitely. So as you have goals, let us know about it, and we'll talk through where the best place to pull that cash is. Secondly, asset location matters. And I just spoke about this with your savings rate. We've had such a good year in equities, particularly if you're in growth stocks. You've had a terrific year. And we do this for you if you're in the advisory accounts that we manage for you. We'll go through in the first quarter and reallocate. That's been part of our process. But that chart that Tara went over, if you could flip back to that for a minute, J.A., I just want to show the listeners here, or the viewers. When you take a look at the different colors, cash in 2018 was the top performing asset. That was the only year of the last 2005 through 2024, that it was the best performing asset category, and that was even below 2%. Notice how many times it was the worst performer. And yes, I agree that cash has never been worth 0, but certainly there was a run where you didn't get much return at all. But if you take a look at large cap growth, it has been a best performer most of those years across 2005. But a diversified portfolio really, for a balanced investor, could somewhat make sense in this time period. And there's been several great years from a diversified plan. But these do trade places. They play musical chairs. And it's important to make sure you've got your assets located in the right spot. Taking a look at the third takeaway, rising income is the only antidote to rising prices. If you were in a growth or even a moderate allocation last year and the year before, you realized this, and it helps you to overcome the worst risk that there is, which is inflationary risk, prices rising. And so to take advantage of that, you have to have rising income. You have to be an owner versus a loaner. And by that, I mean you have to own good quality, durable businesses and invest in those to get the benefits of those. If you're a loaner, meaning you just loan your money to the bank because it's safe, or you're hopeful for a pretty predictable return, oftentimes what we've seen is inflation outperforms your returns and erodes your purchasing power. So keep that in mind and make sure you own rising income. Time in the market beats timing the market. Remember 2022, this was where stocks and bonds both went down. And then, of course, we had 23 and 24. Interestingly enough, in 2022, a test by Charles Schwab compared 5 different investing styles. And we've talked about this before, but just to come back to it, and I don't have a slide for it, but walk with me through this. The 5 different styles investing in the US market was number 1, where you had perfect market timing. You invested $2,000 once a year at the lowest point. So you were the hero and you timed the market perfectly. And this, again, is over 20 years. The second style is where you invested $2,000 per year on the very first trading day of the year. The third style is where you took $2,000 and divided it into 12 pieces, and you invested that money at the beginning of every single month. That's the first business day of every month. The fourth style is the absolute opposite of number one, where you invested at the very highest point of every year. You were the worst market timer, and you got it wrong every single year. And then the fifth and last style, you had money only in cash because you were afraid of what the market might do, and you didn't have any investments. This test found that if you were number one and have the absolute best and perfect timing, that you would come out with the highest returns. That's no surprise. However, since that is nearly impossible to time, the descending order in terms of profits, and this is after 20 years, so the total returns after 20 years was number two. So just investing at the very first day, first business day of every month. Then you had number three. So you invested at the first day of each month. And then number four, you were the worst investor. And number five, cash, was the last. The study shows that if you had perfect timing, you would come out ahead, but not by much. The total returns were within 11% of the perfect market timer. Even the one with the bad market timing came out with 3 times the amount of cash after 20 years. So that's noteworthy, and one of the reasons why we use that principle of time in the market. Number 5, we want to think like an investor, not like a speculator. We talk with CPAs around town, and of course we know from our own clients who have tried this is timing the market and trying to speculate generally yields a worse result than someone who is buying good quality, durable businesses and thinking like an investor in those businesses. They have a much better rate of return. And lastly, revisit your risk tolerance. At the beginning of every year, you set goals for yourself. Some financial, some might not be, but one of those that we want to talk through in the initial meeting is, has your risk tolerance changed? Especially after the years that we've had, or do you see yourself still in that same category or risk tolerance as you had the previous year? You don't always have to keep the same risk tolerance. If your goals have shifted, maybe you have new goals or a new objective, then you can shift your investment allocation to address what's most important to you. All of these are takeaways that we want to revisit with the new year and make sure that we touch on those. Of course, if you're coming into a meeting, we will address these in person or virtually on the telephone, however we have our meetings with you.
Those are all great principles, Greg. And as we kind of wrap up here, we always do like to close our webinars with some biblical principles, biblical wisdom and truth. And normally it's just one passage, but today I have 2 here because I think they are related and they give us a good basis for starting off the year. We can all talk through all the things that we know. We've talked about some of the things from a market and economy standpoint that we know. There are things that we know in our personal lives that we can plan for and expect, but there's always going to be things that happen that are not expected or planned for. And being able to handle and face those unexpected things without fear and anxiety has a lot to do with our relationship with the Lord. And so just these couple of passages. The first is from Peter, 1 Peter 5, 6-7. Humble yourselves, therefore, under the mighty hand of God, so that at the proper time he may exalt you, casting all your anxieties on him because he cares for you. So humbling ourselves, acknowledging that we can't control everything, but there is a God who's in control. And then Philippians 4, 5-6. Let your reasonableness be known to everyone. The Lord is at hand. Do not be anxious about anything, but in everything by prayer and supplication with thanksgiving, let your requests be made known to God. So as we, again, just same thing, talking about anxiety, being anxious, not being anxious. And really, as we move forward into 2025, if we could remember that There will be surprises. There will be things that we haven't expected to happen that will happen. But nothing comes as a surprise to our Heavenly Father. And that is where we can place our hope and trust and confidence, and where we can get peace from. So we will leave you with that. And with that, we want to just close out by saying thank you for joining us on the webinar today. We appreciate your attendance. We appreciate the opportunity to serve you, and we are here to serve folks and to be a resource. So if there's anything that we talked about today that you have a question about, or you think would be beneficial to friends and family, or if you think we could help any of your friends, family, neighbors, coworkers, loved ones, we are here to do that. So please let us know. We do enjoy helping and serving folks, and we welcome that opportunity to continue to do that in the new year. It's hard to believe it's already, what, the 21st of January. So we're off to the races already, but we trust that all of you have had a good start to the year. We look forward to meeting with you and talking with you in the upcoming weeks and days. Thank you guys again. God bless.
Stay warm.